Are you looking at multifamily properties as a passive investment and you're trying to figure out which one is the right fit for you? If so, this is the podcast for you. His name is Nate Armstrong. He is the founder and CEO of Home Invest. My name is Steve Warner, and I am the Chief Investment Officer. And you are listening to Purpose-Driven Passive Profits, where we believe that you can both make great investments, reap the rewards of it, and be a good steward of what God has given you. We practice Matthew 25, the idea of good stewardship. You are listening to Purpose-Driven Passive Profits. Let's jump into it, Nate. So if people are looking for a passive investment, if they're looking at a multifamily deal, how do they find the right deal for them? What actually makes a good deal? And we've got three different things to consider here.
Yeah. Well, the very first thing is that we have to understand the goals of the individual that's doing the investing. Like some people, they're looking for tax savings. Other people, like example, my dentist, he makes a really good income as a dentist, but the reason that he invests with us in our deals is because of the tax benefits that he gets. He gets to offset some of that income, so he doesn't have to pay as much tax. So that might be a goal of some. Other people might have the goal of having cash flow every single quarter or every single month, depending on the investment. Some people depend on that. That's kind of how they make their living. Other people, they're just trying to stack up their retirement accounts. So that way there it grows and their equity builds and builds and builds. So the first thing that I would always ask, and I know you do the same thing, you just helped an investor with a very sizable amount of money. You ask the question, hey, what is your goal? What are you trying to accomplish? So that's how I would do that first. Maybe we could break those down.
Yeah, I think that would be great. The things that you hear when you're looking at multifamily investments, you hear what the cap rate is, you hear what the exit multiple is, you hear what the IRR is. Sometimes they get into what the projected tax savings will be as well. And the thing is that none of these are cut and dry. Each investment you look at is going to have slightly different numbers, and you really need to look at it. So every investment is going to provide some tax savings. Every investment is going to provide some cash flow, some more than others, some way less than others. And some of them are going to provide way more on the back end than they do up front. Those are the three things you're looking at, but it really does come down to what is your first goal? Like out of those three things that we just laid out, is it cash flow? Is it the amount that you exit with so you can stack cash faster in your retirement? Or is it your actual tax savings? Which one of those three is the most important to you? And then that's going to drive your decision. So let's go ahead and jump into it a little bit more. If you're looking for tax savings, Nate, what kind of property are you going to want to look at, and what questions are you going to want to ask when you jump on with somebody?
Yeah. So easiest way. So there's two big things in real estate that you can get. One's called accelerated depreciation that benefits your taxes. The other is called the repair versus replace formula. And when you have to do a lot of repairs to a property, meaning you buy a property that maybe is dated, they haven't updated the kitchens and the bathrooms for a while, and you can go in there and update them, increase rents, things like that. That type of property is going to serve a bigger tax advantage purpose for people that are looking to invest for tax advantages. So look for properties that need improvements, look for properties that need repairs, look for properties that we can accelerate the depreciation on in a fast window of time. Those kinds of properties are going to make more sense. And there's a third category that is kind of a newer thing in the last decade, and it's called the opportunity zone property. If you find a property that's in an opportunity zone, then there's pretty significant tax advantages to properties like that as well. Those they won't be on the shelf forever. They were a thing that got passed as part of a big legislation eight or 9 years ago, but they expire at some point here in the next 5 years or so.
Got it. All right. So if you're looking at those things really quick, the opportunity zone definitely lays out a thought process. The other one is if you're asking an investor questions, like if you're looking for tax, if you're looking for depreciation, if you're looking for the repair versus replace, you're probably going to be looking, in my opinion, more at C and B properties. You're definitely not going to be looking at A properties because there's not going to be much tax there. Is that a safe assumption to make?
Yeah, it usually is. If you're in an A part of town and you've got an A building, that usually means it's a newer building and there's not a lot of improvements to do to it. Usually there's exceptions to everything, obviously, but for the most part, your C class areas, that's like middle working class income type areas and type properties, that's the property that you usually can get in there and have some improvements that you can do.
Okay, awesome. So let's just talk hypothetically. I know we can't share any hard numbers from your dentist friend, but if you're a dentist or you're a chiropractor or you're somebody out there who trades horses, right? We have a horse trader that is in our investment portfolio that has invested with us. If you're one of those people and you have a lot of income and you're looking for the tax break, if you're looking for tax savings, how much per property, like what are we looking at? Just give us some round ballpark numbers of things that we've done for people who have invested with us. And if you're listening to this and you want to invest with us, you're interested, you can click in the description. You can go to homeinvest.com. That will get you on a call with us. We'd be happy to have a discussion with you. All right, Nate, let's go ahead and jump into that.
Yeah, so we have some clients, some partners that invested with us in the building that we took in December. I'll use this as an example. We took this 68 unit building. As soon as we closed on it in December, we went and hired someone to do a cost segregation study. That's just a fancy word for it's a tax specialist that also understands buildings. They understand the tax code, and they come up with a plan that allows you to accelerate the depreciation faster. You see, what that really means is that the government realizes that these properties wear out over time. So they let us take some tax credit along the way to offset some of the income. And so this particular building, the guy that we hired to go out and do the report, he came back and he said, hey, you guys can have $987,000 per year for the next 5 years. So we're like, okay, cool. And so one of our investors, he owns a business. He does really well financially. He makes really good income. He also has big tax bills. We went to him and said, hey, guess what? Because you're 25% owner in this building, you get 25% of this depreciation as well. And he looked at that and said, wow, that's a pretty significant amount. That'll help me offset my tax bill. And this makes sense. I'm in. And so that's like one example right there. Every building's a little bit different, obviously. And just like you said, we can't like pinpoint a number, but like that was a big number for him. That's like, as a 25% owner of the property, that's almost $250,000 in tax savings that will amount for him.
Awesome. So so for him, he gets a huge number of tax savings. He's still getting some cash flow though, and he is still making a 1.8x multiple on the back end. So it's still a good deal for him overall, but that really helps him by offsetting a large amount of his tax burden, correct?
Yeah, absolutely. Like I don't know this to be 100% sure, but the conversations I've had with my dentist, I'm pretty sure he's doing this not for the dividends. He's doing it because of the tax benefits. For him, like he makes enough off of his dental practices. He's got a couple of them. So he doesn't need the cash flow per se, although that we find properties that kick out that he likes the tax benefits more.
Okay, so let's transition a little bit. Let's go to somebody who wants to just stack cash. They have a 401k, they have an IRA, they have some kind of retirement account. They're 20 years away from retirement, and they're like, I just want to see that grow as fast as possible. What is somebody in that boat? What kind of questions are they going to ask, and what are they looking for in an investment?
Yeah, so this is really speaking about equity. Someone that's like parking money, that's retirement money. They usually want it to grow. They want it to multiply. They're not so concerned about like the day-to-day cash flow, because all of the cash flow goes back into their retirement account anyways. They don't like live off that day-to-day. So they want to see their money grow. So what that kind of person is going to look for, if you jump on the phone with one of our team members, like I know Steve, you do a great job helping people with this conversation. You'd want to ask, you'd say, hey, what is the equity multiple on this deal? If I put $1 in, just hypothetically speaking, if I put $1 in, how many dollars do I get back at the end of this project? Does my money do the Matthew 25 parable that Steve mentioned earlier? And so that's kind of the measurement. It's called the equity multiple. The deals that we take, they usually range somewhere between 1.6 and 2.0. And so what that means, if somebody puts in $100,000, if it's a 1.8 multiple, I'll just take the average. If someone puts in $100,000, they would get back up to $180,000 at the end of our project. So that's what equity multiple means.
Okay. Is there a certain kind of property that they should be looking for? Is there something that throws off like a higher equity multiple, but is still safe, still a great real estate investment, if people are looking for that?
Yeah, great question. So typically C area value add. So C area again is like working class. Value add means that we can come in, we have some stuff we can improve, we can add value. As an example, we just signed contracts on a 49 unit that we're buying. We've been working on this one for a year. Beautiful brick building. The city of Lexington, Kentucky has owned it for a long time. And they just discovered now that like they don't want to be landlords anymore. And so we built this relationship over the last year, and now we're taking the property from them. And that property, they haven't, although it's in great condition, they haven't really went in and updated units yet. Exterior looks awesome. The landscaping's awesome, but it's a little bit dated in there. And so we're going to be able to go in there and we're going to be able to update stuff. We'll put in new flooring, new countertops, give it a really fresh vibe. That's a value add. We're going to add value to it, and then we're going to be able to increase the rents on it.
Awesome. All right. So I guess my question, like what pops in my head is, how is that different? Because we talked about C-class properties for both, but this value add is different because it's not repairing versus replacing. It's actually adding to the property. Am I understanding that correctly? Would that be a question that an investor should ask?
Yeah, they should ask that question. So let's define that what you just said for a second. So repair versus replace. So repair would be, let's just say there's hardwood floors. What would happen? Which actually this property has hardwood floors. You have two choices as the building owner. If you need to replace those floors, you might say, you know what, I'm going to go in there and rip them out and I'm going to put in new ones. That would be a replace. You might instead say, I'm going to go in there and I'm going to sand them, stain them, make them look nice again. That would be a repair. Now, most CPAs would agree that when you own a rental property, if you do a repair, that repair is 100% tax deductible this calendar year. And so it becomes more advantageous for someone that's looking for tax breaks to find properties that we can do more repairs to instead of replaces. Replaces, we still get to deduct the expense, but it's a capital improvement. It has to be taken over the duration of the property length. So for multifamily property, it's usually 40 years. So we want to do more repairs. So this particular one, this 49 unit building, it actually is, we do have repairs to do it.
Awesome. All right. So that covers our first two. If you guys are interested in talking with us about it, if you either need tax savings or if you are looking to just stack cash in your retirement account, we can help you with both of those. Again, go to homeinvest.com. Nate just dropped a little bit about the 49 unit that we just got. We've already subscribed 70% of the deal. It's only been live with us for a couple days. So if you guys are interested, go to homeinvest.com. The link is in the description or in the podcast notes. And let's go ahead and jump into the third one, which is somebody that is looking for cash flow in a deal. If you're looking for cash flow, if that is your main thing that you're looking for out of the three, Nate, what are we looking for in a property and what kind of questions would we ask when we're jumping on the phone with somebody?
Yeah, so the cash flow question, here's the property profile that typically cash flow is the biggest play on. It's typically a property that maybe is in a lower C area. Some people will even stretch and they'll go as far as like a D area. We don't here, it's not our cup of tea, but some people do. They'll stretch down to the Ds. They're not looking for the property to go up in value so much, but instead they're looking to buy it at a cheap price and then collect rent off of it and make a really good spread. And so that's kind of the property profile. So